Hi, everybody. Welcome to another edition of Traction's webinar series. Today, we have a webinar on an entrepreneur's guide to fundraising. I'm Russ Armstrong at Boast.ai. Boast.ai is automating the shred claim process. We're using software to make your claims larger, reduce your time and effort putting into it. Excited today to share with you my journey on raising money at Limelight Platforms. Before I joined the Limelight team, I spent 11 years at RBC Capital Markets. I was an institutional equity trader, trading for hedge funds, pension funds, mutual funds, and whatnot, placing large orders and matching up buyers and sellers. Did that for about 11 years. After that, a buddy of mine asked me if I wanted to get into the startup world, and we launched Limelight Platforms. Limelight Platforms is an experiential marketing platform that helps brands who do live experiences capture the data around those live events, which helps them calculate their ROI for those experiences. We raised $10 million from multiple investors and grew to about 50 employees. And today I'm going to share some of the tidbits that I learned from raising that money. I'm now with Boast.ai. I run up sales for Eastern Canada, but this is a story of Limelight. So let's jump into that. So being in the capital markets world, when I left that side of the world, I thought, fundraising would be pretty simple. I thought, you go to an accelerator and maybe you'd sell a 5% stake for 50 or 100 grand and, gain some traction, gain some revenue, then go do a seed round, and then go do a Series A. And there you are, you'd be off to the races and building your $100 million company. I thought it was pretty simple. And then as I got a little more into the details of it, it was a lot more complicated than I originally thought. There were so many different types of rounds, raising money from friends, raising money from families, incubators, accelerators, angels, VCs, growth equity, just the kind of acronyms out there were endless and endless. There was also the types of tools you're using: convertible debt, venture debt, revenue financing, equity, price round, warrants, options, everything else kind of was spinning my mind. So what financing really looked like for Limelight Platforms over that 5-year period was something like this. I mapped out all the different financing rounds that we did over a 5-year period. And you can see from this chart here, I mapped out everything from the type of round it was, from a friends and family rounds, from doing converts, doing price rounds, from doing any debt options that we did, the type of instrument that we used to raise this money. So rather being common shares, convertibles, pref shares, debts, our pre-money valuation. So what we are raising at, how much we raised at that pre-money val. And then for us, our driver evaluation was a multiple on our MRR, our monthly recurring revenue. So I mapped out what our MRR was and our multiple was during those raises to kind of give you an idea of the valuation that you can put on your company too if you're an MRR business. I'm going to go through the kind of the life cycle of the story of raising this in a little more detail throughout the story, but I just wanted to take a step back and kind of introduce it a little bit and talk about the whole fundraising process before we get into talking about how Limelight did it. So first off, fundraising is hard, obviously. We keep hearing headlines that there's so much VC money out there. And, in 2018, there was $3.5 billion that was kind of put into the market, and there was 471, sorry, that's 3.4 million. No, billion put into the market, 471 deals. But what also is happening at this exact same time? There's an explosion of startups that are growing. People are trying to get into the entrepreneurship world. People are trying to disrupt more and more industries. So there's actually more startups competing for the same amount of dollars. I would actually argue that there is actually less dollars flowing, especially to early stage companies, because a lot of the VCs have gone up market and are looking to invest in de-risk companies that have significant track records. So yes, there might be a lot of money available to people who are, north of 100 or 200 in recurring revenue, but those early stage investments in VCs are a lot harder to come by. So here's a little bit further breakdown of how you see those financing deals in the market in Canada. So here's a graph of kind of like where those deals kind of were. So you'll see that, 7 out of every 10 deals in 2018 were under $5 million. So that's quite a few were under there. And a third of those deals were under $1 million. So that's kind of what we're looking at in terms of the number of deals that are actually getting done on a daily or on a yearly basis. So if 200 of those 10 deals were under $1 million, I always kind of think about this in terms of your, distribution as a bell curve, right? If you're going out trying to fundraise money and you're growing at 300-400% and you've got, 100, 150 in MRR, you're going to have a much easier time fundraising than someone who might be growing at 200% or 150% and might have like 50 or 60 in MRR. It's not to say that you're not going to be able to fundraise. It's just that you're going to have a stronger strategy and approach to fundraising. It's not going to be as easy. You're going to hear no a lot more. So just having a process in place and understanding how to drive that process is going to be key to your success for fundraising over that period. All right. So when I talk about what does that mean to actually try and have a process in place to understanding that, it's your fundraising strategy. What is your fundraising strategy? So the first thing I always tell people when they're talking about a fundraising strategy is you need to know how to put a valuation on your company. You need to know what it's worth, and you need to know what the key drivers of that valuation are. For some businesses, it's that monthly recurring revenue and a multiple on that MRR. For other businesses, it might be on the B2C side where it's a little bit more on your active daily users and a multiple against those active daily users or active users. But understanding what those key drivers of that valuation are is going to help you go to market and have a better story about asking those investors for the terms that you're looking for on your financing. So you need to understand what those key drivers are, and then you need to understand how those milestones and achieving certain milestones is going to impact your evaluation. So if you're going, if you're an MRR business and you have a multiple on your MRR and you go from 50 in MRR to 100 in MRR, well, what does that do for your valuation? What does that do for your ask if you're going to market? And how do you use that to optimize your process and get the best valuation that you possibly can? So there's two things you got to kind of keep in mind when you're doing this, because obviously if you knew how to grow your MRR, you would be doing that on a regular basis. So something you kind of have to keep in mind here is, one is adjusting your milestones to match your cash on hand. So your milestones might be, hey, if I'm going to hit an MRR of 100 and then go to market, because that's what my, go to market to fundraise, that might be something that you have in mind. Well, you're going to have to adjust those milestones to the cash you have on hand. So that would be your burn rate to make sure you're not running out of cash. Or if you're not going to hit those milestones and you're not going to hit 100 in MRR, you're going to have plan B or go out and fundraise to raise that additional cash to bridge that gap to get you to that 100 in the MRR where you can actually go to the market and raise that money. So you got to kind of balance the two of those and understand how that's going to impact your valuation and your fundraising process. So what we're really trying to avoid here is your strategic being and not being out of money and going bankrupt, obviously. So for those who are kind of newer to the fundraising process, when you go out and ask for a pre-money valuation, if your pre-money valuation is, call it 5 million, and you're raising $500,000, your post money will be 5.5. And then obviously you're spending that money. So you're going to have a depleting cash reserve in your bank, and you're going to start to, burn that cash. But your idea is, before you run out of cash, you're going to want to hit a milestone where you can go to market and raise more money at a higher valuation than that post money value that you did previously. Because if you run out of money before you've hit those milestones, that's when you're going to see some pain, and you're going to have to make some tough decisions around your company. All right, so valuations. Let's talk about valuations a little bit. I kind of hinted to this a little bit earlier from a Limelight standpoint. We had kind of a pretty consistent between 7 and 8 times multiple on our monthly recurring revenue. The rule of thumb is 6 to 9 times. Now I say the rule of thumb, there's obviously outliers. If you're growing at 3, 4, 500%, you're probably going to get a multiple that's well above 9. But if you're growing a lot lower, you might get something in the 5, 6 range. So just keep that in mind. But the rule of thumb is around the 6 to 9 times. Now, how do you determine where in that range you kind of lie? Well, here are some of the metrics that kind of you can do your own calculation on to figure out what kind of multiple you should get. And that could be your total addressable market. Are you solving a problem that has a total addressable market that is in multiple billions? Or are you building some solution that is a niche carve out of an industry that nobody else is tackling, where your total addressable market will be a little bit smaller? Obviously, the larger the addressable market, the higher the multiple you get, the lower the addressable market, the lower the multiple you might get. So that's one key thing to keep in mind. Obviously, your team is very important for the multiple that you're going to get on it. Second time founders, you always hear stories about second time founders commanding higher multiples and having an easier time raising. And that's definitely true. I mean, going through the journey myself over 5 years, I would have to say that it was quite kind of eye-opening in terms of the amount of information that you kind of attain, launching a startup and, getting your hands dirty and everything from finance, sales, marketing, HR, product development, to your strategic fundraising process, to everything. So going through it once and going back out to market. So your team is hugely important in how your multiple affects your raise strategy. Obviously, your timing and going to market at the right time. Our multiple was probably limited a little bit from the fact that we were a MarTech company, so marketing technology. We were raising in the 2014, 2015 time period. The heyday of MarTech was really between 2006 and 2010, where you saw, more innovative MarTech solutions coming into market. That's when you saw the launch of MarTech dedicated funds. So when we went to market in the 2014, 2015 period, a lot of the MarTech funds had deployed their early stage capital, being that, when you talk about VCs, if they raise $100 million fund, they might have, call it, 50 million that is for follow-on investments and 50 million that's for new investments. And obviously, as that fund ages, they might not have much money that they're allocating to new investments anymore. They're all holding back that funds for follow-on investments down the road. So for us raising kind of after that timing period of when it was kind of a hot market, we definitely saw a squeeze on the multiple that we got on our MRR. So that sector, again, is kind of what I was touching on there. But again, on that sector, it could be, what is that hot topic right now? Are you building a blockchain solution? Are you building something around the crypto space? Are you using AI and ML? Are you, doing some deep learning that's impacting what you're building? So a lot of these will make a big difference as well in terms of, are you kind of building something new in the solution in the market, or is it, a sector that's been around and doesn't have a lot of upside for innovation? So that sector also will impact your valuation. Obviously, your growth rate, that's one of your biggest ones. If you're showing revenue growth in the 300, 400% range, it is going to be a lot easier to raise money, and you are going to see a massive expansion in that revenue, recurring revenue multiple that you're going to get on your valuation. So your growth rate is huge. And then obviously logos is another key thing. A quick story from Limelight. We were selling, as I was mentioning, an enterprise experiential marketing platform. So we were selling into Fortune 100 companies. We sold into automotive primarily. That was one of our bigger spaces. And I remember we got a meeting with Sequoia Capital down in Silicon Valley in the 2015 period, where we had some big logos on our deck because we were already doing work with some of those businesses. And we got a meeting with their head of enterprise SaaS, and we went into the room, and the guy who ran it up came in and he said, "Apologize, I don't have a half hour for you guys today, but I do have a few minutes, and I was really curious on the companies on slide 8 and why they're paying you." So we flipped over to slide 8 and we told them why they're paying us and what the workflow was that they're paying us around. And he said, "Thank you very much for your time. I got to go, but I really appreciate you guys coming in." And we walked out of the room, and me and my co-founder looked at each other, and we didn't really understand what was going on. But the only reason, for him, he was trying to, he knew the market, he knew MarTech, he knew enterprise, and he knew SaaS. He was trying to figure out if there was something that they were paying us for that he hadn't thought of before. And once we told him kind of our reasoning around it, he had all the information he needed. He already knew everything else about the sector. He knew, the market size, the addressable size, the go-to-market, the pricing strategy. He knew all those things just from going through our deck. But those logos got us in the room. And those logos will also get you a valuation bump depending on who you're working with. So don't discount that ever. So another thing to keep in mind as you're fundraising, your valuation is not linear. It's going to change over time. Your growth rate's going to change over time. Your team, your sector, investment thesis from VCs are all going to change over time. And as those change over time, so will your valuation. So keep that in mind as you're fundraising. And we'll kind of come back to this a little bit later when we talk about that MRR and making sure you have a consistent pipeline over your raise cycle, so you're not falling into some hits as you're going through the process. So let's talk about fundraising process a little bit. I kind of talk about fundraising process in the exact same way I talk about a sales process. In terms of, you are going to be told no quite often. It's not going to fit their mandate. It's not going to fit their why they care and what makes them interested in, why they want to invest with you. So I kind of treat it as a sales process. You need to know your VCs. You need to know your clients. You need to understand what makes them move. So you're going to have multiple people in that funnel. You're going to have 100 plus in that. So, in terms of the reach within Canada and the US, you're going to have to do a lot of due diligence into the types of VC funds that will actually care and invest in a company similar to what you're doing, depending on sectors, specialties, B2B, B2C, whatever it might be. You need to understand that before going to market. You're going to have to set up a drip, and I mean by a drip campaign, you're going to have to set up a narrative where they're going to have to get excited about your story. They're not going to cut you a check in 2 weeks. They might want to see your progress over a 2, 3, 4, 6 month sales cycle to understand what you're doing. So you're going to have to set up a campaign to make them excited about it. What are you going to say to get them excited about it? Another thing you always have to be doing throughout this process is, because you want so many people in your funnel to be dripping, you have to always be prospecting and adding more people into that funnel. There is no harm in asking those VCs if they have other people that they would recommend you meet with, if other people have theses surrounding what you are doing that they might have an interest in. That's what we're trying to do. You're trying to find a VC that has a thesis in the space that you're disrupting. So you're trying to match what you're doing and your disruptive nature to what that VC is, because that's your most likely way to get a check from somebody if you're kind of along the lines and they've already done the due diligence into the space and understand that it's ripe for disruption. I always suggest to some people to work backwards. So kind of like that chart I had up previously, build one out yourself just as an example, just to kind of get you into the headspace around what you might be raising, different, amounts you might be raising, what those valuations are. You can do some cap table analysis off this and understanding how much you'll actually own at those different times if you do some of these exercises. What your key is having a FOMO story. So you need to have a fear of missing out story. So what are you going to tell those investors? I always talk to, when I advise people on how to go out with their strategy, what you want to go to market with is, your story needs to be about the inevitability of your success. So we are going to win this space because we are doing this, and talk about how, they're going to miss out on the opportunity. So you're trying to create urgency around the opportunity. So they'll write you a check now, and creating the narrative of, if you don't invest now, you're going to miss it and you're going to have to pay a higher price at a later date. So creating that fear of missing out story is key to your process. Again, also, term sheets get term sheets is an interesting kind of concept. When it rains, it pours, I guess you could always say. The idea behind that is, whenever you're fundraising and you're running through your process, you're probably going to be, if you have 100 people at the top of your funnel and you finally get down and you're talking to maybe 2 or 3 different VCs or investment partners, and one person gives you a term sheet first, there is definitely a lockup period where once you sign that term sheet, you are then in a quiet period where you can't go around and shop that term sheet to other people. But if you are down the road and have other VCs in your data room before you've signed that term sheet, I find it's your obligation to circle back with those VCs to tell them that you are about to sign a term sheet and that you will be going into a lockup period if they don't make a move quickly. I feel that's only a reasonable thing to do, as opposed to, calling them up and being like, oh, I signed a term sheet and I am no longer available for investment. So you have that kind of brief window where, before you sign the term sheet, you can circle back with people you're talking with to try and get them to go. By doing this, and what we found is, we kind of, through the Limelight fundraising process, that we, probably got 2 or 3 extra term sheets out of that by leveraging that kind of short window where you are having multiple people in your data room and doing due diligence on you. And also always have plan B when going through your fundraising process. I've heard horror stories, and you never know what's going to happen in terms of the VC or the portfolio. Obviously, principals leave at some of the VCs, and that principal could be responsible for your investment. And if they leave the VC, the partner who picks up that your file going forward might not have the same thesis, might not agree on the investments, and might pull the plug on it. So always have a plan B in place. You can't just rely and put all your eggs in one basket when it comes to financing. All right, so recapping this a little bit. So just to kind of quick idea, always have lots of people at the top of your funnel and ask those investors to make more intros for you. So kind of recapping that, you might have 20 at the top of your funnel, maybe 20 respond, 10 go into in-person meetings, and one term sheet at the other end of it. So keep that in mind. I always say when you're knowing your clients, keep a G sheet and keep records of it. I'd say when you get into like Series A and beyond, you could probably start using a CRM to kind of help you with some of that automation. In the early stages, you're not going to want to spend the money, so definitely just use a G sheet to kind of keep track of it. Know everything you possibly can. Know everything about those VCs. What other companies do they have in their portfolio? Would you be complementary to the portfolio? Would it be a tuck-in, or is there a similar company already at that in the portfolio where it doesn't make sense? Knowing everything about them, what their interests are, what their likes are, just make it a very personal relationship and keep those records on a G sheet. Another thing is very, very important is to managing your growth over your raise timeline. Obviously, you're going to want to continue to show revenue growth, keeping your growth rate in track. So, you'd want to avoid the scenario where, say your plan is to go to market as soon as you hit 50 in MRR, but you fast tracked a couple contracts and you have a very weak pipeline behind that after you signed, got to your 50K in MRR. If you are doing your fundraising process and showing no growth over that 2-3 month process where you're fundraising, then you're not creating much of a FOMO story. And two, those VCs might get cold feet and kind of drag their feet a little bit longer, waiting to see some growth kind of turn back on the cap table. So not to say that you can predict when your growth is coming and how you're going to sign that revenue, but make sure you have an extremely healthy pipeline behind your growth before you go to market, because you need to continue to show that. And that will also help speed up your process. And I'll show you what I mean by that a little later with some of the strategies we have. Last thing I'd say is definitely make sure you're asking your VCs the right questions. Don't be afraid to ask for intros. Don't be afraid to ask if they know other VCs who have theses in your space for what you're disrupting, and ask them about their portfolio. Ask them if they're still making new investments or if they're only making follow-on investments. Ask them how much they've deployed of the fund. These are questions that they will happily share with you if you ask, but are not always forthcoming unless you ask the right questions. So understanding those VCs, obviously if they're down to the last 1 or 2 investments out of that fund, chances are it might not be as much of a fit. But if it's kind of an early in the fund and they're still haven't made an investment out of that fund yet, the chances of getting that investment might be a little bit higher. So keep that in mind and make sure you're asking those questions. All right, so that's kind of on the strategic standpoint of fundraising. Now I'm going to go into the fundraising process and how Limelight did it, and just walk through some of the different stories and multiples around how we raised money at Limelight. So we'll start off here at the top here. Back in August 2014, we did a friends and family round, which was for common shares. We had a 1.5 pre-money valuation. We raised 150, and this was more just, passing the hat around the co-founders of the company to put some money into it. We had probably a larger multiple than we should have at the time, but that was just kind of the basis that we could get away with, because we weren't dealing with an external factors and external people who were going to carve that down a little bit more. After that, we raised that initial 150. We went back out to market a couple months later and started to hit a wider network, and that was with angels. These were with family offices and high net worth individuals that were mutual connections of the company. We went back out to market. This is when we started to see our multiple come back in line a little bit for what we saw over the rest of our fundraising process at about 7.6. As you can see, our MRR was starting to increase quite fast, which was also a good sign and great for the market. And then after that, we went to an accelerator. So in February 2015, we went to Acceleprise. Acceleprise has offices in New York, San Francisco, and now Toronto as well. Toronto just launched their first cohort, so please look them up if you're in the Toronto area and looking for an amazing accelerator. They have some amazing LPs, including Nick Mehta from Gainsight, Tian from Zuara. The access to the knowledge base that they have is unbelievable. The content and really helping early stage companies, especially if it's your first time as an entrepreneur, really guide you towards getting things done and accelerating your company. We always had a kind of philosophy at Limelight to fail fast. So, let's not spend 15 years trying to make this work. Let's go to market, raise some money, and try and build a $100 million business as quick as possible. And if we fail along the way, well, that's fine, but fail fast and learn as quick as possible. So that accelerator was key for that. On the flip side of that, obviously, the accelerator was great also for the fundraising process post graduating the accelerator. And I'll get into that a little bit, but I just want to touch on a couple things first. Early in our cycle, we were asked to clean up our cap table. And I always came back to people and I was wondering, well, what does that actually mean, clean up your cap table? So one of the things that meant by cleaning up your cap table was making sure the people on the cap table are going to carry the company into the future. If you're going to be a founder and you're going to underpay yourself and work extremely long hours and travel all over the place, then you need to make sure the lottery ticket on the other side of the scenario is going to be enough to make you motivated to continue to drive that growth in the company. So if it's not the case, what can you do to fix that? You can issue additional shares in the company and assign those shares to the people who are going to drive that value of the company in the future, which is pretty much what you have to do to ensure that your cap table represents the people who are going to carry the company. The second thing is obviously your IP. So think of it in terms of IP, not only from the company's IP, but also your employee IP. So all employment contracts should have an IP agreement in with it as well, that all IP generated by the employee is product or is owned by the company. So think about that as well, not only in terms of like contractors who might be doing development work for you, but in terms of your employees internally as well. All right, so we graduated the accelerator and then we went to market with some convertible debt offerings. The first one was in May 2015, where we were trying to raise $250,000 in converts at a $5 million pre-money valuation. Worked out to post 7.6 multiple. This was converting into common shares. And then post that, we got our first institutional investor, which was a convertible debenture also, but it converted into pref shares. And this is when our MRR was at 85. Our growth rate was outstanding. And we got our first institutional investor at this time. It was a Midwest VC who gave us $100,000. That was pretty much a placeholder for them. And what that placeholder meant is they got access to information and it gave them kind of the rights to potentially lead a Series A down the road if we continued to deliver on our growth rate as they were hoping we would. That VC didn't open up their Rolodex or their network for us. They didn't open up kind of their expertise or provide any additional consulting, but they did want that opportunity to lead a Series A down the road. So two sides of that, didn't get the full benefit of the VC and how they would help us. But what we could do is leverage that initial VC to go back to market and say, hey, we got our first institutional investor. Here is their track record. They're interested in us, so we can go close the rest of that round by people being impressed by who has joined our cap table and joined what we were doing. So it was validation that we were on the right track when we signed that, which was definitely helpful. So the convertible debenture world, converts and safes, very close to the same thing. I mean, the one thing I'm always a big fan of converts for is that because they're long form, they cover a lot more of the scenarios for fundraising and conversion than you would see with safes. Safes were originally developed by YCOM. No one goes to Y Combinator and graduates without raising another round, which is why they have these safes, which it converted pretty much as soon as they graduated. So there's just a lot of scenarios on a short form safe that will not dictate how it converts into equity in the event. So, in the event that you don't raise additional capital, which maybe could happen, how does it convert into equity at that stage? Or does it just continue to be a debt instrument on the books inevitably, into the future? So understanding that is a big deal. Obviously, the other pros of raising converts or safes, if I generalize the two of them together, there's a lot less due diligence. You're going to have a data room, but it's not going to have the same level of diligence you're going to have to go through. They're easy and they're cost effective. You can raise, the amount of money you want when you want. You can be very creative on the terms, so in terms of discounts or caps that you're using as incentives for those investors. And one of the other big pros is you're not going to have to rewrite your shareholders agreements, which I'll get into a little bit later. Here's a strategy that we had when we were going to market, and it was about linking your valuation to your convert cap. So think about that as our MRR was linked to our convert. So at 50K in MRR, we were raising at a $5 million cap, and we were raising 250. And we also told our investors once we hit 80K in MRR, we were no longer raising at that 5 cap. We were going to be raising at an 8 cap and raising an additional 250 at that time. So what this was doing was creating urgency around the investors where they'd need to invest now to get that 5 cap. If you show them this and then show them your pipeline, and say your pipeline was quite full and quite healthy and it looked like you were going to hit that 80K in MRR within the next few months, you're creating urgency around them pulling the trigger on the investment now at the 5 cap, which helps you close that round. But you have to be pretty straightforward about this with your investors and tell them this is what your strategy for going to market is, which will allow to create that urgency to help you close those rounds a lot quicker. The general rule of thumb for fundraising is if you're raising less than $1 million on converts and safes, use converts and safes in that sense. But as soon as you kind of get over that $1 million threshold, you should be looking at a price to equity round. So what did we do after that? We went and did some SR&ED financing. So SR&ED financing, for those who know the SR&ED program, we'll just touch on this really quickly. It was actually, the updated stats on this, it was $3.5 billion given back to 20,000 companies in 2019. And you can get big money back. So 64% of salaries can come back if you're a CCPC. And having that much money come back, you can then, if you're burning quite a bit of money in those expenditures, you can then finance that to have that cash flows come in a lot quicker. So, instead of waiting to file your taxes at the end of the year, you can fast track those and get quarterly drawdowns against the accrued expenses that you have for your R&D. And you could get that cash flow, 9-12 months ahead of time than what you typically have to wait. The financing rates for SR&ED financing, you range from the 10 to 15%. They'll do claims as small as 50K. I would say probably more like 2-3 week turnarounds. 1-2 seems a little bit short, but I would say that go out and develop these relationships now. Do not wait till you need the cash to go develop these relationships. Developing these relationships now will speed those turnarounds up to 1 to 2 week period. You must have your claims prepared by a reputable firm. So keep that in mind when you're going to market. You need to have somebody that's going to actually has a track record of producing claims that the CRA accepts. And then for paying it back, the interest is capitalized. And once that refund gets returned to you from the CRA, that's when you pay back the loan at that time. All right, so then we did a seed equity round. So this was a priced equity round, which was preferred shares. Once you do this priced equity round, all of your convertibles that are outstanding on your cap sheet will then convert into equity. So you no longer have debt on your balance sheet. We raised at a 10 pre-value, we raised 1.7 million, around the 8-time multiple. Our MRR had just peaked over the 100K in MRR, which is kind of a key threshold for a lot of VCs. They want you to see around the 100 in MRR before you go to market to raise capital. All right, so raising equity, what did that actually mean for us? The pros of raising an equity round versus a convertible debenture. The valuation and ownership is defined, therefore people know exactly how many shares they own. The conversion has taken place, and in the event that they actually own equity as opposed to a convertible, they're more likely to provide insights and open up those Rolodexes and their network to help grow your company. From a con standpoint, the negative side of that is obviously your shareholders agreement, and you're going to have to open that up and do a lot of work into some of the different terms around that. It could be very long and time consuming to do it. Also, you're giving up board seats at that time. They're going to want to have access into your board meetings. There's going to be a little more corporate, corporate diligence done on that side in terms of your structure and your reporting mechanisms. So once that equity is given up, it becomes a little bit more of a process in place to, making decisions at your company. All right. After that, we did a seed bridge round plus equity. So you'll see over on our MRR side, we started to run into some problems in terms of our revenue growth. We only grew from 105 in November 16 to 120 in July 2017, which was quite slow on our growth rate. So we had to go back out to market to rate a bridge round or a seed plus round, or they even call seed plus plus now. So you've seen people go back to market becoming a lot more common at this time. This was kind of a flat round in our perspective, as we were talking about earlier. Your post money valuation, so your pre plus what you raise, gives you your post. So we went back out to market about 7-8 months later at a flat round where it was 11.7, but we also had to give up warrants. So you could argue that there was some downside that was negative to that. And we raised an additional 600,000, which we forecasted would bridge our gap because we were in negotiations down the road on a very large contract, which was going to spike our MRR, but we just weren't there yet and it wasn't over the line. So that was going to bridge our gap to get us to that point. So options and warrants, obviously options, if you guys are familiar with it, you're gonna have to develop an ESOP, an employee stock option plans. This is used to help hire new people and also get advisors' attention. So when you're going to market, they will be able to open up your Rolodex and help grow your business. Generally, it's 15% of the fully diluted float that's outstanding. And you will have to increase this float as you do more rounds to make sure that you have an adequate amount of available options to allocate to new employees as you go through your growth stages. Warrants are just long-term options to buy equity in the company. They're generally used as sweeteners on rounds. Sweeteners would be if you're raising a certain multiple, this will give the VCs extra money to buy at a discounted price in the future. You could see warrants used on equity or venture debt deals, which we'll talk about in a little bit. So we're going to run through the debt side of this a little bit right now. The non-dilutive financing benefits, so raising debt as opposed to raising equity. Obviously, you're not giving up any equity, you're not giving up any board seats, and you should be fighting for no personal guarantees, especially if you've already raised money from investors. You don't own 100% of the equity, so you shouldn't own 100% of that debt, so no personal guarantees. You want to extend your runway before an equity round. Obviously, the idea here is that if you can go borrow money at an interest rate, and if you buy 6 more months of runway, and you can grow your MRR by another 30, 40,000, and that impacts your valuation, the valuation impact and the dilution on you is more than offset by the interest rates you're paying from buying that runway to grow your company to get that optimal valuation when you go to market. You could also do this to bring forward cash flows to hire key components. So it could be hiring a developer, it could be hiring your marketing and sales team to grow that out to continue to grow it. So here are the kind of categories that they're bucketed into in terms of non-dilutive financing options: secured debt, bank debt, venture debt, revenue financing, shred financing, and then some government debt options that are out there. And then obviously other government grants, which you should have on your radar as well. So I'm going to run through all of these pretty quickly. In terms of secured debt, this would be from banks. This is an operating line. They're typically prime plus, so interest rates in the range of 5 to 9%. Generally, banks want you to have north of 100K in MRR, and what that means is they'll give you a 4 to 7 times multiple line of credit. So you'll be able to have access to $400,000 to $700,000 in debt if you have 100K in MRR at those interest rates. The red flags that you really have to keep an eye on, and this is what the banks will be worried about, will be if you are more on the B2B side, the churn rates are generally higher when you have B2B or B2C clients. If you have too much revenue within a couple businesses, if you have like 2 clients that are paying you 80% of your revenue, that is a big red flag and they might turn it down, or your gross margins are not as high as they'd like it to be. Another big aspect of bank debt is coming from if you have an institutional investor on your cap table. Obviously, the bank's mandate for a loan is to earn back their principal plus interest over the loan period. If there's an institutional investor who's on the cap table, even though things might not go great, they understand that the institutional investor will most likely continue to finance the round, even if it is a down round, to continue the company to go on because of the IP and the revenue that they're generating, which kind of acts as a security blanket for the bank to make sure that they get their principal plus interest paid back over that period. Venture debt is just a little bit more on the risky side. So interest rates start to go up. You might see interest rates in the 13 to 20% range for venture debt. They might want warrants on top of that. Generally they will see a little bit more of a risk appetite. So you might see some venture debt providers will get involved even below the 100K in MRR. They might get involved at the 60, 70K in MRR if your growth rates are there. They will be subordinate in debts, which means that they are not first in line to for any collateral that might be on the balance sheets. They will go second or third in line. Traditionally, they are the kind of the same red flags as you'd see from bank debt, except they will willing to take on more risk than the bank's profile will. Revenue financing is another interesting aspect. This is pretty much a loan against your current revenues. They might have to pay anywhere from like 25 beeps up to 4% of revenue, depending on what the loan is. And the idea here is it's a 3-time cost of capital to buy it back out. So if they loaned you $1 million, you would have to pay back the $1 million. You'd have to buy it out for another $1 million, which makes 2. And then they're hoping to make $1 million in those royalty payments. So that $1 million loan will cost $3 million by the time you're paying it back, which is kind of the basic math on those revenue financing. Here's a quick chart. We will circulate this deck around so you can take a look at it, and it kind of goes through the different comparables of cost of capital from venture capital, private equity, revenue financing, venture debt, and senior debt. Some other government debt options that are out there: FedDev Ontario, they got another $1 billion to allocate over the next 6 years, which is quite interesting. There are 3 streams. 2 of them are non-repayable. 1 of them is repayable. So definitely check out FedDev Ontario for access to government money to grow your business. Another interesting debt program, which was one that Limelight took, was SOFI. It's a smaller program, but has a great risk profile and will fund companies with debt, which previously would be beyond what you could get from any other companies out there. So take a look at SOFI. In terms of other government grants and tax credits, SR&ED, as I mentioned, is the largest program in the market. There's 63, where you can get up to 63% of your R&D spend back as cash if you're a CCPC. And then in terms of IRAP, that's another huge one in the market where they can fund 50 to 80% of innovative projects with cash up front. And then if you guys want to check out some other top grants that we see in the software space, go to Boast.ai and look for our funding innovation guide, and we have 20 programs on there, which are the most popular programs that our software and internet companies are looking at in terms of taking advantage of for other free money from the government. Here's a quick kind of landscape map of who to contact and in what space. So just so you know who to contact if you're going out to market to try and raise any of this capital. From a venture debt perspective, the biggest players are Espresso Capital and Firepower. From revenue financing, Flow Capital to Maya Capital. From the mezzanine debt, venture debt, BDC, SVB, and Comerica. From SR&ED financing, Easily, Venbridge. From a senior debt standpoint, Roynat Capital, which is Scotiabank's arm, RBC and the KBI Group, CIBC Innovation Banking, and then BMO are on the debt side. And then EDC is a great partner to come to the table with you. They do a lot of loan guarantee programs and help fund any export growth. They are key to reducing your interest rates if you're doing bank debt, as they will help with some of the loan guarantees, which will lower your interest rates if you're doing business with the banks. So if anyone needs a contact to the EDC, please reach out and we'll be able to help you with that as well. So kind of wrapping it up here, we'll just talk quickly about our Series A. At Limelight, we raised almost a $5 million deal after we landed a large deal with BMW North America. Because our growth rate was starting to slow and we weren't seeing the explosive growth we saw earlier, we saw our multiple get compressed a little bit, but we did end up raising it a pretty significant round at that time. Traditionally, what you'll see if you're raising a debt or a big deal like a $5 million Series A is you'll have venture debt providers who will give you more money on top of that. The best time to raise venture debt is after you raise a Series A. Raise money when you have money and therefore you have access to it. So we did that also at that time. So something also to consider. After this, we're going to kind of wrap it up at this point. Um, you know, kind of tailor off the story. But if you have any further questions about the fundraising journey and the entrepreneur's guide to fundraise, please let me know. As for Boast and what we are automating as much of the shred claim process as we can. We tie into your tech stack like Jira and GitHub, and we run algorithms against those tickets to kind of point our tech PMs in the right direction. We are the only tech-enabled shred consultant in Canada. And we produce larger claims for less money. So please reach out if you'd like to get more information on Shred and Boast. Otherwise, please reach out with any questions. Happy to do some follow-up questions if you want to ping me at my LinkedIn profile. It's Russ Armstrong. Thank you very much for joining us again today, and we'll talk again soon.